So we recently conducted a survey amongst 3,276 investors and traders in our Piranha Profits community with the aim of finding out which stocks are getting the most attention. And boy, were there some interesting picks. So curious to know which stock took the crown? Keep watching to find out. So we did this survey at the end of last year asking this question: what are the top 3 stocks on your watch list right now? So let's see which stock makes it into the top 10. Unsurprisingly, the Magnificent 7 actually sits tightly in the top 10 with honourable mentions Palantir, Disney and Alibaba alongside them. If you were to dig deeper under the hood, these two groups have polar opposite characteristics. On one hand, the Mag 7 had a great run in 2023, most experiencing significant gains of between 48% to nearly 240%. Alibaba and Disney, on the other hand, let's not talk about it. A picture speaks 1,000 words. Palantir just doing Palantir things, making one of the biggest comeback in 2023, riding on this current artificial intelligence wave. Now, here's the interesting thing. Just 2 weeks ago, on the 11th of January, Microsoft actually surpassed Apple's market cap to become the world's most valuable public company again. Call this the law of large numbers or the wisdom of crowds, but it seems like the majority has made their expectations clear. Microsoft is the fan favorite. So before we dive deeper into the most popular stock, here's a public service announcement. So for those of you who are on the lookout for stocks to add to your watch list, I'm pleased to share that Piranha Profits is hosting our live online event called Outlook 2024, where Adam Khoo will be sharing his game plan and how you can potentially 2x your profits in this rare Goldilocks year. So all attendees will get Adam's January market analysis report and a top 8 stocks list. So spots are limited, quickly sign up with the link in the description below. So we'll see you there. Now, back to Microsoft. So given the monstrous rally we've seen the stock experience in the past couple of years, investors would no doubt be slightly skeptical of how much more it can run from here. In fact, some are even calling this AI wave a massive bubble in the making. So let's try to acknowledge the bear side of the argument first. From both an absolute and relative valuation perspective, Microsoft is far from being quote-unquote cheap. So when looking at Microsoft's historical PE ratio, their current 40 times earnings is definitely a tough pill to swallow. From a forward PE perspective, when comparing with its Mag 7 counterparts, they are only lower than Amazon and Tesla. And we all know both Amazon and Tesla is notorious for having high PE ratios. So what's the deal with the market tagging such a premium to Microsoft's valuation today? So in short, Microsoft has time and again proven their worth to investors that they not only have a phenomenal business, they also have a world-class management team. So amongst their 3 main business units or verticals, personal computing, productivity and business processes, and intelligent cloud, they have shown nothing but growth from strength to strength. The personal computing division, which comprises mainly Windows, search, gaming, and devices, they had seen a slight slowdown and compression in margins after coming out from the highs of the pandemic and, more importantly, the stimulus money, where consumers were spending frivolously, upgrading their devices and playing more games as they were stuck back at home. So coming out from this high base effect, we are seeing a significant drop in the demand for devices as seen from their latest quarterly results, with revenue from devices actually down 22% year on year. But in our opinion, this is probably the only laggard in their entire business, and everything else will likely look better from here. Moving on to their productivity business, which mainly comprises of Office 365, both commercial and consumer subscription, LinkedIn, and dynamic business solutions. So the bulk of this division's revenue is derived from subscriptions. So you can clearly observe that they exhibited very steady and predictable growth in revenue, coupled with improving margins over the years as they optimize their costs and efficiency. So their margins for this division alone is now above 50 whopping percent. 50% mind you. Moving on to the last vertical, the intelligent cloud, which is made up of Microsoft's public, private, and hybrid server products and cloud services. So it's essentially the crown jewel of Microsoft today. Look at the rate at which they're growing their revenue while maintaining strong margins of over 40%. So it's a business that founders are willing to die for. Also, according to global data, the cloud computing market size is expected to grow at a CAGR of 16.3% over the next 3 years to 1.15 trillion in 2026. So the implicit assumption here, we are still in the early days of the cloud computing business, and Microsoft, alongside Amazon and Alphabet, is primed to take advantage of this tailwind. So when looking at a company's stock price, especially one that has significantly appreciated, it is easy to attribute it to the company's performance because they are usually supported by strong earnings results and also an overall good story that sells to investors. So in Microsoft's case, let me show you a few charts to prove my point. So this is the revenue growth and operating margins over the years. Looks good? This is the net profit margin for the last 10 years. It has never been higher. This is the trend of their return on equity. Can it get any better? I think you get my point. So couple this with the compelling story that Microsoft is the king of software with no close alternative, making its revenue stream anti-fragile even during an economic downturn. Microsoft Azure is standing at the cusp of the cloud computing boom, and their investment in OpenAI is going to be a game changer to both search and application in this AI revolution. There is really nothing to not like about Microsoft from an investment standpoint. However, we always want to consider the other side of the coin too. So what can actually go wrong from here? For one, everyone seems to be fairly confident of the predictability of Microsoft's recurring income even in an economic downturn. What if, I'm just saying, what if it's not as strong as expected? Similarly, for its cloud computing division, what if it's not as exponential as everyone has initially thought? Lastly, it's of course regarding the rapid expansion of AI and its associated growth. What if the story falls short and it doesn't translate to real revenue and income growth in the longer run? What happens next? So all these are just alternative views to consider, and clearly we don't know what exactly the future holds. But we do know that management is still optimistic as they provided a midpoint guidance for revenue to be right around 60.9 billion US dollars. And this would be a 15.4% year-on-year growth on such a massive revenue base. So analysts are also expecting Microsoft's EPS, earnings per share, to be around $11.21 for the year ending June 2024. And that is a 14.3% growth year-on-year. So all things considered, Microsoft is definitely one of the highest quality companies in the world that we see today. So if I were to just ignore all this storytelling and just crunch the numbers via a DCF model using the following assumptions, I get an intrinsic value of Microsoft to be right around $390 to $400 per share. And that is basically the range that Microsoft is trading right now. Therefore, I wouldn't necessarily say that Microsoft is cheap or expensive at today's valuation. So do leave in the comment section down below on what you are intending to do with your Microsoft position, if you have any. And for those of you who don't have an exposure right now, are you going to add Microsoft to your portfolio anytime soon? So this is CK from Piranha Profits signing off, and as always, till next time, keep winning.